Crypto markets remain choppy over the summer as jobs data disappoints, but dips get bought quickly as rates markets price in a cut in September. Ethereum still leads the charge with all-time highs in sight as call spreads get rolled higher. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larkin from Options Insight. Got my man Dave from FRNT. How you doing, man?
I'm good. How are you? Good break?
Yeah, got a bit of a tan in France, south of France.
Nice. And markets are looking lively?
Yeah, well, Bitcoin's still kind of where it was, right?
Yeah.
Had that little dip on a weak non-farms print and then roofed it straight back.
Yeah.
But Ethereum, the one that you've called, is going to hit new highs. You said what, 3 weeks ago? You said it was going to hit within a month.
Yeah.
And we're only 10% away.
Yeah. So I think we're getting there.
Yeah, we are getting there. What's been going on? Like, what is going on? Are they still? It looks like they're still continuing to buy big chunks of this in the treasuries, right?
Yeah. I think as we said before, I think Ethereum is just a pure demand supply dynamic.
Yeah.
We had just over $1 billion of inflows into the ETH ETFs yesterday.
Right.
Now again, some of that's obviously going to be
against futures, doing the basis
and all that
trade
stuff. But
yeah,
I thought it was interesting. Remember, we were in Dubai and Mitch from BlackRock was on and said that they reckon only about 15% of
which is a lot lower than we thought.
A lot lower than we thought.
In Bitcoin, that was
in Bitcoin.
Yeah.
I don't know how that stacks up against ETH, but there's a lot of inflows into the ETFs, and they're outpacing what you're seeing in Bitcoin. And then also we've got all this explosion of all the treasury companies kind of running the Michael Saylor playbook for ETH. I just saw before we came in the studio that Tom Lee and with Bitmine, what they're doing on their treasury, they just upsized the ATM offering, I think by 20 billion. I saw us coming
20 billion.
Yeah.
And what is that? What was it before that?
So I'm not sure, but
okay. But that's a huge number though.
It's a huge number, and there's a lot of money sort of coming into the space.
But like Tom Lee's obviously copying the Michael Saylor playbook here, right?
Yeah.
So he's obviously figured out, well, we're having so much market impact that our initial purchases are just killing it. So why don't we just keep snowballing this thing, right?
Yeah. What's quite interesting for me, like we talk about narrative and the importance of narratives, and like ETH has been so unloved. And there was kind of never really a cheerleader, like a prominent cheerleader. Like if Bitcoin had Michael Saylor, ETH didn't have one. And Tom Lee's like a really credible guy. Would love to get him on here actually and talk to him. But really credible guy who's super experienced markets guy, who speaks really eloquently about why he's buying ETH as the treasury strategy. He's been talking about this is kind of what Bitcoin. When Bitcoin was at 1,000 type moment. So he's getting everyone excited about what the potential upside is, but really kind of highlighting things that we've spoken about before, about the fact that like the institutional world is building on ETH. Yeah,
they're trying to bring all assets on chain. And if they bring all assets on chain, what chain is it going to be on?
Yeah, and they're all looking at ETH for that.
Yeah.
Obviously this, since the Genius Act and the stable coins and that explosion and that continued adoption, over 50% of that settles on ETH. So again, that kind of like internet of value, that settlement layer, for everything coming on chain.
I have to say though, looking at the chart, God, it's overbought up here, right? But it doesn't matter, does it? If it's overbought, that's the thing. You can't trade it like in the same kind of way that you would normally, knowing that this demand isn't about to disappear.
Yeah,
is it?
but that's a really interesting comment, because I always try and distinguish between the kind of short-term fast money leverage players that probably are a little bit leveraged up and overbought here, which you're always then going to see those guys get washed out and chop themselves up. But then on the flip side to that, I think the kind of real money, if you like, is underweight and underpositioned. the whole story
Yeah.
for the last, well, you just look at the Bitcoin dominance chart. It's breaking down now,
Yeah.
but it's been Bitcoin dominance because the big, real sticky money's all been going into Bitcoin.
Yep.
And now I think they've got the narrative to start just reweighting a bit and coming into Ethereum.
And that's why Bitcoin kind of struggles. It's not really able to hold new highs or anything.
Because I just think there's that rotation. I'm still super bullish, obviously, on Bitcoin.
Yeah.
I still think we go 150K over the course
But it's
of
an
this year.
orderly move up now. It's not a parabolic one. Because like it's the alts that are parabolic now.
Yeah,
especially ETH.
yeah.
But what about the other alts? Like I'm surprised at how relatively weak Solana has been, and I would have thought that would have caught a decent bit. Even Sui hasn't really gone nuts either.
Yeah, but I think that's because we're still not being, this is kind of a real almost institutional move again, and we're still not seeing like retail come in and go, man, it's picked up, but and maybe that starts to, if ETH leads a broader like alt season, but I think it just speaks to the fact that these are kind of real institutional flows, and Bitcoin had captured that and dominated that for so long, and now you're starting to see the rotation into ETH. So that's where the narrative is right now. It's not in Solana or Sui at the moment. Now again, I expect retail comes in and they'll all start moving out the risk curve, and so with even some of the institutions, that once they can buy more, Solana and these other things. But right now, completely the narratives with ETH, it's been underloved for a long time, and you look at all the charts. I mean, if you're a chart guy, you're looking at ETH was so depressed against so many different assets that it's now you're seeing that unwind. So point taken that it could feel a bit stretched, but I think the underpositioning is such that I think this move can sustain.
Yeah, I'm not going to fight you on that one, but it'd be interesting to see if we make new highs though.
Yeah, what's happening in the vol world on ETH?
Yeah, so in the vol world, I mean, ETH is definitely where the action's at, right? So it's been realizing double Bitcoin. So Bitcoin's realizing 30, ETH's realizing 60. And that's just holding, right? That 30 vols of outperformance in realized has just been there for ages now.
Yeah.
And arguably it's been even higher at times. The kind of the implied vols are similar, like kind of double the spread. So like Bitcoin's at 35 with ETH close to 70. The ETH curve tends to be a bit more flat to inverted because that gamma's performing well. Bitcoin curve tends to be contango because it's kind of a bit sleepy and not doing too much. And there's a bit more comfort in supplying gamma. Contango means upward sloping. So the front end is cheaper than the longer end. And that's just because the gamma supply keeps coming because you're being rewarded for being short Bitcoin gamma, but you're not so much in Ethereum, basically. Right.
Okay.
And then on the skew surface, you can see a clear dichotomy, right? You can see Bitcoin put skew is there in the front end. So people are using puts to protect Bitcoin holdings, right? Whereas Ethereum's flipped back to calls again, basically, right? So definitely, you can see quite a big contrast between what the skew curves are looking like in ETH and in Bitcoin.
Yeah, and further out, like what
further
market
out
positioning?
Yeah, further out are similar, right? I mean, ETH calls are trading nearly close to 4 vol premium on the skew in the long end, whereas Bitcoin's only still in calls, but only 1 vol. So definitely more upside kind of excitement, let's say, in Ethereum and in that story. Obviously, Tom Lee's targets of above 10K and stuff have got people willing to own that upside. There was a big trade, actually, that was rolled up. So a December call spread that was bought months ago when Ethereum was trading like 2,500. Guy spent like 12 to $15 million, obviously killed it with Ethereum up here and has now rolled that further up, basically. So it's still in December. So they gave themselves plenty of time for the rally.
Yeah.
The rally happened earlier probably than they thought it was going to, and now they're just rolling all the strikes up, right? So
what sort of strikes then do they do on that?
So it did something like 3,200, 6,000 was the call spread. 32 to 3,500 was the front strike. 6,000 was the back strike. We've now rallied into kind of above 4,000 area. They've made a decent amount of money on what they spent. So they decided to take that off the table, roll it up to something a lot cheaper, like a 4,000, 6,000 call spread, something like that. maybe a 5,000, 7,000 call spread, those sort of things, still in December, but gives them a ton more leverage and allows them to take a load of premium off the table, basically. So
Well played.
yeah,
well
definitely.
Played
Definitely. It wasn't looking so great when ETH tested 2,000, but yeah, it's definitely come good.
Yeah, it's been quite a move. I mean, I think as well, it's interesting. We came into August, summer lull, August as well, and September actually are typically seasonally sort of bad months for risk. So I think everyone was a little bit, again, probably came into August like a little bit underweight everything. Expecting us to sort of sell off or at least just consolidate and drift nowhere. So again, these moves just feel painful to me. I mean, even equities, Nasdaq closing at record highs last week, like people keep finding themselves underpositioned. It's almost creating this like pseudo short gamma in markets because people are underpositioned. And then, as you know, a lot of risk managers who are indexed to the performance of these assets. And if they're underweight, they're then forced to chase it, and so they have to reweight up because they can't keep underperforming that index. So it feels like everyone was expecting just like summer lull and maybe a little bit of risk off. We had obviously, feels like forever ago now, but it was only 1st of August when the
that's when I flew to France.
And then the 7th of August when the tariffs come in, and again it's like one of those things that. I mean, the impact of those tariffs might kind of start to feed into data.
Is it going to show up in CPI? Because it hasn't shown up today, has it? We just had the data out. Market liked that data.
Yeah, like a headline came in at 2.7%. I think market was expecting 2.8%. It's still kind of continuing this. Inflation's still sticky. And it's not coming down, but it's not accelerating higher.
But does it give them enough room to cut? Because the market's pricing in a cut now in September for sure, right? And you mentioned, we were talking before about the Bank of England just cut as well, didn't they?
Yeah. So the Bank of England for me is interesting because they cut 25 basis points. The labour market is, I think we're at highest levels of unemployment in 4 years, and that's the reason that they're kind of sort of taking these precautionary cuts and seeing this sort of slowing growth. Now the Bank of England have only got one mandate, inflation at 2%. And they've cut, even though they're forecasting inflation to hit 4% in September. Okay. So even the Fed at least have a dual mandate, like full employment and inflation at 2%. The Bank of England don't.
So what are they doing then?
So they're obviously concerned about the slowdown, and you'd argue that all these things are correlated,
lagging.
And like if you see the slowing down in the labour market and growth, then that should start to pull down demand, which pulls down inflation. So that'll be the way they're looking at it. But I think, and I wrote about this in my Connecting the Dots newsletter for London Crypto Club this weekend. I think there's just an unspoken acceptance of a higher inflation level.
Yeah, but they just don't want to admit it.
They can't admit it because as soon as you admit it, as soon as you move the goalpost, then you can always move the goalpost, and then your credibility as an inflation targeting central bank just completely falls away. Because if you're going to say it's 3%, then if we get there and we start trading above, then does it become 4%? Does it? So
then your currency starts dumping, and your bond market starts dumping, and rates explode, and all that. Right?
And as I always say, like this whole financial market hangs together on confidence, which can disappear in an instant, right? Okay. So I kind of think quietly they've accepted like higher inflation. If you look at what's going on in the US, what's changed the narrative, and now we're pretty much fully priced for cuts in September. Is the fact that we had that really weak non-farm payrolls print, particularly the downward revisions to previous non-farm payrolls. So something I've been saying on here for a while, there's been this underlying weakness in the labour market, and that's now really starting to rear its head. So the Fed is fully focused on that.
Is that AI driven?
That's a good question. Well, I think there's a few things. I think that plays a part. I think probably a bigger thing is Trump's immigration policy. So there's less people coming into the workforce on that, which shouldn't really affect the unemployment rate. But the unemployment rate did tick up as well. You're
hearing more and more companies talking about how they're automating 30-40% of their workflows and stuff. So it's like, surely that is going to lead to less jobs.
It's going to, and particularly if you think of if given Trump's immigration policies, the sorts of people that that's going to impact at the lower end, of the kind of salary scale, and they're the jobs that, well, if the inflation pressure's there, if the wage inflation pressure's there, well, then the incentives are there to replace that with AI and automation and whatnot.
Yeah.
So I think there's some interesting.
Do you think stagflation is in our future?
Yeah, I do. And I last week we had the ISM data out. The ISM services data, and it was that stagflationary print that everyone fears. I think we printed in terms of activity 50.1, so barely in expansion territory, but prices were at the highest level since 22 in the index. New orders falling, so it was activities falling, prices rising, and initially markets sort of knee jerked and sold off on it. And again, just as we've explained before, stagflation's the worst scenario for risk because you've got the growth slowdown, but the inflation constraint stops the Fed or other central banks being
liquidity
able to,
being pumped in.
Yeah, and do anything to arrest the slowdown. So that's why risk hates that.
But
scenario.
usually gold loves that, right?
Gold loves it.
But gold's not loving it right now, right? Is that because of the tariff thing that Trump's talking about on gold?
So.
Because gold's been consolidating since April?
Yeah, I mean, gold's still doing it. Gold. Yeah, gold and Bitcoin are two best performing assets this year.
Yeah, I'm not denying that. I'm just saying, if the news, if the latest data is showing a stagflationary tilt, you would have thought gold would continue breaking higher. Yeah, like crypto's kind of doing basically. Yeah, right? but gold's taking a breather.
Yeah, I think my reason for gold taking a breather, and it's something I've spoken about as well before, is I think we're still seeing this, what I call leaking out of risk premium from markets. So we had this huge risk premium baked in, obviously back in April for the tariffs, and we're pricing some pretty sort of bad scenarios under that. And then we've also had the risk premium around geopolitics, and with the invasion of and the bombing of Iran and all this stuff.
Okay, so it's as we're more likely to see peace.
Yeah.
Gold loses its geopolitical bid, even though it still retains a bit of a bid
for the inflation hedge and all this sort of stuff.
Yeah, so that makes sense.
Yeah, so I think you're just seeing that, which is why Bitcoin's still doing kind of short terms being that outperforming as well. So I think, look, there's a lot of interesting dynamics at play. But
is there any risk those markets ever going to have a correction? Because it doesn't feel like it.
No, it doesn't. Look, what I said with that stagflation fear was, and this speaks to the point I'm making about this kind of unspoken acceptance of a higher level of inflation in the economy, because we had that ISM print, and then we had Fed speakers coming out basically saying we expect to cut in September, and we're basically more concerned about the labour market, which is so. Stagflation is not a problem if the Fed are going to cut in a way, if they've kind of let that side of it go, which eventually, by the way, gold will catch up with that and rip, as will Bitcoin.
But I do agree, the Fed speakers have been relatively dovish, except for Powell. In Powell's presser after the FOMC, started talking about hikes. Yeah. The market hated it. So what's going on there?
Yeah.
It's very strange, right? How he's being so defiant in the face of all the attacks from Trump.
Yeah. Right? I mean, look, I think... if you sat in Powell's seat, stood in his shoes, inflation's still way above target.
Yeah.
And the labour market, whilst it's showing signs of slowing, unemployment's still at that decent levels, right?
Yeah, so maybe it's that credibility issue that you talked about at the Bank of England. If they're seen to relent to Trump's demands so easily, that dents credibility of the central bank.
Yeah, and you got that. And then that was the other thing last week. One of Trump's, even though it's only a temporary Fed pick, I think it's Stephen Imran, if that's the right name, has gone in there. So now Trump's starting to pack it out with people that are going to
do what he says,
carry out his economic agenda. So we're going to have an easier Fed in a way.
But it's interesting because you look at how many cuts are priced in. There's more cuts priced in the period while Powell's still there, right?
Yeah.
Than there are for when he leaves, which somewhat surprised me.
Yeah, but I do think part of that's been we have seen the economic data slow. So I still think real rates are probably too high for the economy. The caveat to that is we're still printing fiscal deficits north of 6%, which is why all the recession calls keep getting faded out. And it's why I keep saying we're in a Goldilocks scenario, because we've got slowing, not collapsing growth, and it's hard to see how growth completely collapses when you're printing fiscal deficits above 6%. Inflation's sticky but not accelerating. So given that there's still globally this shit ton of liquidity that keeps pumping into the system, it's got to go somewhere. Like we've not got sufficient risks out there, I don't think, to drive that big sell-off.
I mean, any sell-off just gets bought like so fast. Like you blink and you miss it. It's incredible.
You blink and miss it. But again, this is why I say we're a function of like rates and liquidity, and predominantly liquidity. Because
I mean, I normally trade a fair amount off seasonals, right? Especially when I trade volatility, because it tends to be quite a seasonal sort of asset.
Yeah.
And it just amazes me, like how we were expecting some sort of weakness to kick in around August time.
Yeah.
So I thought like that sell-off that happened on the jobs data was quite timely, right? Right around the time you'd expect some sort of weakness. But the fact that it just went straight back to the highs within a week is kind of unbelievable, right?
And again, I think that's partly because of where we came from in April, and I say this leaking out a risk premium. And I think markets have been underpositioned. And again, everyone's waiting for the dip to get repositioned.
There's a lot of like meme stock craziness going on now, though. The problem is like, sure, Insta's underpositioned, et cetera. But like some of the names that are going parabolic are like these meme names, right?
Yeah.
And that's starting to feel a bit like 2021 euphoric kind of stuff going on, right? That's the concern. Like it's not just the high quality stuff like Nvidia that's ripping. Yeah. Some of the real low quality stuff's going as well.
The other thing as well is like to sound a bit of a boomerish and be a bit boring. Like if you want to look at, I mean, I don't think earnings and that matter. Like, and I'll get crucified from former colleagues saying that. But like, look, we said functional liquidity, like, and partly as well because there's so much liquidity and wealth in the world looking for a home. This is like the argument for Bitcoin, right? Like it just needs a home. But like there's so much money that flows into index funds. So these index funds are buying. So if you're a Nasdaq and there's money flying into ETFs or whatever that track Nasdaq, they have to just hold like
they're not price sensitive. That's the passive flows.
It's all these passive flows. So the money's coming in, and that money's like, Nasdaq's up another 10% or whatever. I'm going to put it in there. No one's doing the calculations. Go, hang on, is Nvidia good value? What's the PE ratio of Nvidia up here? Is it justified? What's my earnings forecast? Most of the money that comes into that is so passive that it's not even thinking that. That's why I say that earnings they matter, but they don't matter. But even if they do matter, we've just had an earnings season, and 80% of companies beat their earnings forecast. Yeah. So that's partly because of inflation.
Palantir, the most overvalued stock on the planet, is trading at 130 times sales now. Yeah. And since earnings, which I think was like a week and a half ago, the thing is up like 20% or something. Yeah. It's crazy.
I mean, it is crazy. And so I think that's partly because of the passive flows. But again, particularly something like Nvidia, they keep hitting the numbers to justify like their valuations in a way.
Yeah. So they're growing into their valuation.
And as we always say, like my whole, big core part of my thesis for Bitcoin is currency debasement. The value of the dollar is weakening. And not just the dollar, all currencies are, because we're all playing the same stupid games. Yeah. So like I would expect like everything's going to go up in dollar terms in a way.
Over time.
Yeah. So, and you're looking for the assets that I can hold that give me the best hedge against that debasement.
And you've got to decide your time horizon when you're investing, right? Like, are you a trader trying to nick every swing in the market? Or are you just zooming out and saying what's happening over the next few years, basically? And I don't think you're going to get much argument that over the next few years, this kind of train continues running, right?
Yeah, so. And look, we're still, if you look globally, global M2 still like rising at almost like breakneck speed. You got a global rate cutting cycle. This is why actually I think the 4-year cycle gets extended, because I think the rate cutting cycle, the monetary cycle is getting extended. And partly partly because of this sticky inflation. And again, we came out of like just, COVID was we kind of, it was such a sort of massive like hit to the economy and everything. And then the response was so huge that all cycles have just been changed and elongated because of it. So we've had this like really kind of slow cutting cycle. Like the Fed are still cutting, we're about to go into another cut next month. That's getting drawn out. So I still think, we'll be cutting into next year and possibly QE and all that sort of stuff comes. So therefore, whilst we're easing everywhere, whilst liquidity is rising everywhere, then assets are going to keep going up. There will be interruptions and there'll be sort of risks along the way where we get the 5-10% corrections in stocks.
Just a question of how long do they persist, right? Like,
how long do they persist? And like you say, at the moment, I think market's underweight. And then if we bring everything back to crypto and you've got this whole idiosyncratic story where, I mean, another big thing last week is Trump signed executive order to allow 401ks to invest into crypto.
Yeah.
That's like $12.5 trillion capital pool that
can allocate some percentage.
Start to allocate.
Yeah.
So there's just a huge like demand dynamic and huge amounts of capital flowing into this space. We spoke about it. We've had countless guests on here talking about, everyone's impatient in markets. We want markets to quickly re-rate to where, is everything priced in. But what's going on with this administration and, the rolling back of some of this restrictive regulations or the implementation of regulation, providing those frameworks, the amount of companies now coming into the space, you just now, this is why this is an exponential secular trend. And I think you're starting to see that sort of demand sort of flow in. And then really, like when we think about is a market overvalued or is people overweight, it's like everyone really is very, very, very underweight sort of crypto, partly because they've not been allowed to be in it for the last
so they're kind of dipping their toes in rather than going all in.
Yeah, they're dipping their toes. That's what I mean.
But there's a couple of players who are going all in because they're the aggressive ones, like your Tom Lees and Saylor in 2020 went all in.
I think that's why Michael Saylor's like in such a rush to ramp this up, because he's like I need to get ahead of it. He knows what's coming down the pipe. He knows that everyone else is coming in. He knows that every billionaire in the world sat there right now going, maybe I should allocate a few percent to this thing. And there's just so much. There's, depending on how you want to measure it, $700-800 trillion worth of capital in the world, and what's Bitcoin, like what, 2.5 trillion asset? It's such a small percentage of global capital, and yet you got to think that it's going to capture a decent amount of that capital. And I think we're starting to see that come in, and we're still obviously highly correlated to risk, and I would talk about at the extremes we can outperform risk, but right now global liquidity is rising. We've climbed the wall of worry, be it tariffs, be it geopolitics. I actually think the next kind of issue to navigate will be as the debt issuance increases, and there'll be some pressure on the front end. But then the Fed's going to have to come in and do that. But we might go through a bit of a funding kind of wobble. But even with the quarterly refunding announcement, they've kind of kept what we call coupon issuance, i.e. like longer dated treasury issuance, stable. So despite raising the amount that they need to raise, so basically got to do it at the front end. So that's keeping a cap on yields. So that's kind of like yield curve controlled, or what's it, the guys at Cross Border Capital call it treasury QE. So they're playing all those games. So much liquidity, so much financial repression that I just think like we're going to see a kind of blow off top move for risk over the next few months, and Bitcoin probably going to lead the way if ETH doesn't beat it to it.
It feels like ETH probably is the one who's running away with it. All right, sounds good. All right, we'll call it a day there. Remember, don't get, this, it might be overbought in the short term, but if you zoom out and you have a long-term view, this train has probably still got some room to run. All right, guys, don't forget to like and subscribe. We'll catch you back here next week. Cheers.